Okay, folks, this is Larry Carrasco at Insmax Insurance Brokerage, and I want to welcome you to another installment of Insmax Insurance Brokerage Thursday webinar series. These are hosted every other Thursday at 1 o'clock Eastern Time. And again, we thank you for spending a few moments today. Our 20-minute presentation will cover post-election planning, specifically related to estate planning for clients with a net worth under $10 million. We also have a presentation we call the Business Owner's 5-Year Plan. And we think it's got some legs, and we believe that it can work for a lot of your pass-through entity clients. But before we get started, we'd like to provide some information about who Insmax is and what we do. Insmax is a full-service insurance brokerage operation. We share ideas and concepts that solve real-life problems, and we work with our advisors to help their clients. We have over 20 years experience in this space, and we work with more than 30 of the major insurance companies. We provide training, customer-approved marketing content. This way you can approach your clients with good ideas that are easy to understand. We handle your contracting and licensing, and when your clients want to implement a plan, well, we can help you with that too. We also review pre-underwriting questions to uncover and address your client's specific impairments. And this way we can determine the best insurance company for their risk. We also give our advisors all the forms to complete the application, and we review those forms for errors and omissions. We handle the entire underwriting process from application to submission, including scheduling exams, ordering medical records, and negotiating better offers with the underwriters. So in short, we're a full service brokerage company that you can trust. We like to say, we're the insurance experts, so you don't have to be. So let's get into today's topic, shall we? Well, the election is over, but not necessarily for estate planning. You see, regardless of the results, there are no direct changes to current law as it relates to the estate tax situation. In fact, both candidates are bound by the rules that exist today. In 2018, the Tax Cuts and Jobs Act set aside new gift and estate tax exemptions. And in 2021, that exemption is $11,700,000 per person, and double that for a married couple. This is slightly more than current levels. However, if nothing happens, all of these higher numbers revert back to the pre-2018 levels. We're about $5 million per person. But as we all know, nothing ever changes in Washington, and certainly nothing ever changes with taxation, right? Well, how about a history lesson, especially as it relates to estate and gift tax history? What you see on the left side of the screen here are bullet points here, which indicate multiple changes that have happened in just the last 17 years. And I think you can agree that the one thing we cannot count on is stability. But the one thing we can count on is what we know today, which means if we take advantage of the opportunities that are presented to us now while the laws are where they are, your clients can do some excellent planning. Again, who knows what's going to happen next? So let's just take a look quickly at the Biden proposal as we understand it. Under this proposal, gift and estate tax rates would revert back to their 2009 levels, or exemption amounts of about $3.5 million per person for estate tax and $1 million for gift tax exemption. In addition, at the top bracket, the marginal rate on these taxes will be 45%. Another potential gotcha that's often overlooked is the elimination of the step-up in basis on inheritance tax on inherited assets. This could be a tax that touches virtually every person who inherits a company, real estate, or equities. By eliminating the step-up in basis, the beneficiary would inherit the original basis of the asset and then would have to pay full capital gains on the entire value when a sale occurs. Now, this is a sticking point with a lot of politicians, and we'll see how it goes. But again, in Washington, anything's possible. With a single party controlling the Senate, and that's a possibility, and the House, and certainly the executive branch, changes may happen prior to the expiration of current estate and gift tax levels 5 years from now. So if you're rich and you're worried about the estate and gift tax levels changing, maybe the time to start planning is now. But I like to say, what defines rich? It's all different with everybody I know. And as this slide describes, we're going to try to project the federal tax that might be due for an estate tax, assuming death occurs in 5 years. So for the next 5 years at these different net worth levels, 2 million, 3 million, 4 million, and up to $10 million, we're going to grow it at 6 million, or excuse me, at 6%. And we're going to presume that death occurs 5 years forward. At that level of growth, we wouldn't see any sort of federal estate tax on any of these folks until they get near around $10 million. And even here, the projected tax on my screen is $672,902. However, none of us knows when death will occur. So unless your clients are planning on passing away in the next 5 years, we may want to take a look at the future. So assuming the same values as the previous screen and the same present net worth, if death were to occur, say, 25 years in the future, around life expectancy, presumably, and the current law goes back to pre-2018 levels, the tax bill here would be significantly different. In fact, it's applicable to every one of the families on this chart. They would expect to have some sort of projected federal tax. So for disclosure here, we're not factoring in any sort of additional estate planning that's done or grandfather carry forward of anyone else's unused gift or exemption. This is just straight planning. But under the Biden proposal, it doesn't get that much worse for estate tax anyway, as it relates to the reversion numbers back to pre-2018 levels. It does go down to 3.5 million. And again, every single person in every one of these levels, in terms of present net worth, is going to have a pretty large tax bill that they're going to have to deal with if, in fact, death occurs about 25 years forward at these hypothetical rates. Something absolutely to consider. So let's talk about planning today. Let's take advantage of the huge gift exemptions that families presently enjoy. Let's utilize some trust planning to grow these outside the estate. Gifting some assets in a trust is not the end of the world. Clients can still maintain control depending on how their trust is created. And let's potentially utilize life insurance to provide some sense of certainty or future legacy planning. Insurance has wonderful qualities like a tax-free death benefit, guarantees. Heck, it can be used to diversify a concentrated stock portfolio that may be heavily weighted in a particular sector or asset. And you can do all of this planning in terms of future legacy planning for pennies on the dollar. But the earlier your clients begin, the lower it will cost them. So let's start planning today. So here's a simple example of what I'm talking about. A friend of mine at an insurance company once told me to hire the insurance carrier to pay the future tax bill. And that's a different way of sort of thinking about planning. So in our example, for a male and female, both 65, who would acquire $1 million death benefit on a second-to-die basis, we've got some guarantees built into this through their life expectancy and a projected lapse date as projected 20 years after life expectancy. The cost for this protection is about $20,000 or 2% of the benefit. One might say if a client had $1 million portfolio you were managing, would they be willing to allocate about 2% of the earnings on that portfolio to ensure that they would provide a source of funds for future taxation and also ensure their legacy plans would be carried out? That might be a good question to ask someone. Here's another compelling reason to consider this. And this is an excerpt from this second-to-die policy ledger. You will see not only are we providing the death benefit, But the rate of return at life expectancy, age 85, is 8.1% and nearly 5% by age 90. And if you factor those into a tax-free adjusted IRR, those numbers could be even higher. Not too bad using a conservative product like life insurance when you think about it. So we want you to recognize that there are resources available to you that are just waiting to be utilized. That includes advanced marketing attorneys and design specialists at the carriers and here at our company as well. We would love to work with you to help your clients. We can even help you with client-approved presentations, take you through all the concepts. Just give us a call, and we'll start from there. Now, with that behind us, let's take a look at the other part of our presentation today, the Business Owner 5-Year Plan. So, since we have 5 years remaining on the 2018 Tax Cuts and Jobs Act, I call this the 5-year plan because we only have 5 years left. And under that Tax Cuts and Jobs Act, we had a substantial reduction of federal income tax brackets that all of us have enjoyed for the last few years. But there was also another little gift that was included under Section 199A. Now, Section 199A is the subject of its own webinar, and we'd be happy to visit with you about the specifics there. For today's presentation, it's going to be very high level. So in keeping with that, Section 199A, generally speaking, exempts 20% of pass-through income from taxation. Now, there are some phase-out limits that occur when the pass-through income goes from $315,000 to $415,000. And it's also not available for certain professions. They can't get this deduction. So for all the lawyers on the phone, I'm sorry you cannot enjoy this tax break. But let's do a simple calculation of the tax savings, shall we? Assuming 20% of a $300,000 pass-through income would not be subject to tax, that would give us $60,000 times the tax rate of 30%, which would mean, in this example, your client could save $18,000 in actual federal taxes. That's quite a lot of money. So while we have 5 years to plan, let's do something with this 18K. We have an idea, which is to allocate the tax savings to provide another benefit to the owner that he might not be considering today. Since current rules will expire in 5 years, we only have that much time to do something with this tax savings. And I think everyone on the call recognizes that taxes are going to go up. We're not exactly sure how much. With a huge national debt and a $1 trillion deficit in the annual budget, the federal government's going to need to find money somewhere. So let's talk about planning tax efficiently for your client. Here, we're going to compare allocating these savings for future retirement and long-term care needs. In fact, we can show a side-by-side comparison of putting money into an equity account versus an insurance-based savings plan, and then show income comparisons. After that, we're going to show you the power of an asset-based long-term care design that guarantees more than $1 million of tax-free long-term care benefit. Wow. So let's get started on that. So what you see here is an output comparing allocating $18,000 to both an equity account and to an indexed universal life policy. The equity account, for purposes of our discussion here, was projected to have a 7% average growth rate, a 30% income tax rate for the client, an average capital gains composite rate of 22%, and we assumed a 25% portfolio turnover. And finally, just a modest 75 basis point management fee. The life insurance policy, on the other hand, assumed a 6% average return on the S&P index on a 1-year point-to-point basis. And for this particular product, it happens to be less than their historical look back. So what we did again was allocate the 18K for 5 years into the equity account. And then we can show side by side is an income draw on a tax equivalent basis from both the equity account and the life insurance policy. So we can size them up. And then what we can also show you is which one has a longer advantage to your client. In this particular page, what you're seeing is through the power of tax preferred loans and tax deferred growth inside a life contract, the income stream actually lasts longer. In fact, in this example, the income on the equity account goes to 87 versus 96 on the life insurance policy, yet we still maintain a tax-free death benefit throughout the whole transaction. And what you can see is that more than $165,000 of income was paid out using this design than the other design. If you have a desire to see any design that you want, different factors, different variables, we've got the software that can do that for you. So let's talk about asset-based long-term care, shall we? So I'd like for everyone to understand, and I think we all do, that long-term care costs are projected to be massive in the future. Heck, they're high today. And assuming today's $300 a day benefit at a 3% inflation rate is going to cost $728 or $265,000 in 30 years. So the question is, how are we going to plan now to handle that? Well, using the 5-year plan and allocating these tax savings now, we can provide a guaranteed long-term care arrangement, which also, if the client chooses, has a return of premium benefit to it. So they can cancel the contract and get back all dollars paid into it. So let's see this example. Using the same $18,000 allocated to an asset-based policy with a 5-year inflation rider, your client can expect to receive more than $1,400,000 of long-term care benefit pool by age 80. In fact, this is a great product because you can actually use the word guarantee in it. It's contractually guaranteed. Now, this one page doesn't do the whole presentation justice, but just recognize that, we're going to start off a little bit small here with a day one benefit of $250,000 on your $18,000 5-pay. And ultimately, with the inflation rider, it grows all the way up to $1.4 million. Pretty impressive. We can split the number up between couples and maybe design a different contract. So here's a variation on the very same one. It's a combination of the last two strategies where we use a permanent life contract that happens to have a chronic illness or long-term care rider attached to it. And using those riders, the carriers will allow a portion of the death benefit to be paid for long-term care benefits. In fact, with some carriers, it can go from 1% to 4% per month of the death benefit. So an example might be if a client had a $1 million death benefit with a 4% long-term care rider, the customer could effectively receive up to $40,000 monthly for long-term care. I mean, that would certainly be a lot of distribution, but it's not out of the realm of possibility that could be a future cost. Now, these policies can also pay money to the care providers directly through a reimbursement benefit, or using an indemnity-based plan, your clients can actually receive the check themselves and allocate those monies in any way they see, say for a home improvement or maybe for a loved one that's given up a job to help care for someone at home. Either way, both benefits are paid as long as they qualify and cannot perform 2 of the 6 activities of daily living. Many people call this type of insurance the kind you don't have to die to use. I took that line from another carrier, and it's apropos here. So what else can we do for business owners? Well, between the insurance carriers, ourselves, and our team that we can bring to bear, we can discuss key person benefits using life and disability. We can discuss retention programs, buy-sell protection plans. If you haven't discussed estate equalization with clients that have children in the business and not in the business, now might be the time to do it. And then there's another technique out here using borrowed money from a commercial bank or premium finance loans. Historically, we're in the lowest interest rate environment we've ever seen. This might be an excellent way to present an estate plan or a business plan to an owner. In the end, we'd love to just engage with you and your clients to design something that can help them achieve their goals. I reiterate, we've got resources for you, advanced planning teams and designers, client-approved presentations. Folks, we've got a full toolkit that's just sitting here ready to use. All you have to do is ask. So what I'd like to do in just a moment is open it up to questions. We're going to be unmuting your calls. I do want to thank you in advance for joining us today. And we urge you to give us a call about today's presentation. We are switching it up a little bit. That next week, we're going to be doing our concentrated stock solution next Thursday, not 2 weeks from now. It's an asset diversification story, a simple idea, especially for those clients that are heavily weighted in a particular stock or sector. So if it's okay with you, I'd like to unmute everyone's lines, and we will. And if you have a question, just go ahead and ask, and we'll attempt to answer it. Well, okay then. Well, thank you very, very much again for visiting with us today. We look forward to helping you with your next case. Have a great, great day. Bye-bye now.